My name is Marco. I'm Marco Sherblom, originally from Finland. I'm the founder of the company. Previously, I built a very similar business to Fiinu, which was an overdraft style lender. That business lent and recovered over $1 billion worth of small overdraft style credit in the UK. I'm a former professional athlete and have a peculiar interest in overdrafts, as I have a PhD in them as well as in artificial neural network. Chris, why don't you introduce yourself thereafter?
Thanks, Marco and Jonathan. So I'm Chris Sweeney. I'm the CEO of Fiinu PLC and Fiinu Bank. Rather more mundanely, I'm a career retail banker. So I've done 25 years, or circa 25 years in retail finance, predominantly with high street and UK banks. So Barclays Bank, I've worked both in the UK and abroad with Barclays. And then most recently, I was the CEO of Vanquis Bank, as well as 118 Money. So, first-hand knowledge of operating in the UK regulatory environment and first-hand knowledge of consumer finance. So should we cut to the sort of chase in terms of the presentation? So we're going to really try and do four things, as well as obviously answer any questions that anyone has towards the end of this. The first is give you a case for the plug-in overdraft. That we see a compelling opportunity in the market. We'll explain that in a little bit more detail and how our product works and why that opportunity is truly attractive. We'll explain a little bit of the journey that we've been on. We'll also then spend a few moments talking around our leveraging our integrated service platform. So whilst we are a bank and our primary opportunities is around the bank and our product, there are also opportunities with the technology, and we'll spend a few moments on how that may evolve. And then at the end, or towards the end, we'll then step through the actual product for the bank, how it works, our target audience, and a very high level view of the sort of the business model and the business case. So, and then obviously opportunity for questions. So that's the intention for today. So if we on the next slide, I'll just click on. What you'll see is a timeline here, and this is designed to show you not the whole of our journey, but how life has got interesting for us since 2019, and then right up to the present day. So a quick sort of recap without anyone who, unlike Marco, hasn't got a PhD in overdrafts, just to sort of give some context to the overdraft market and what has happened in the UK, and therefore why we believe this is a compelling opportunity. So if you cast your mind back to 2019, 33 million people used some form of overdraft in the UK. Now, there was then, as a result of some industry dialogue, there was a major overdraft reform. And what effectively happened was the regulators didn't particularly like the way the existing banks had been offering and pricing overdrafts. And so some of you may well remember there was a degree of coverage around the use of unauthorized overdrafts and some of the punitive fees that were potentially charged. And therefore, the regulators suggested that the banks reform themselves, remove the lack of transparency and remove charging of fees. And what happened is the banks did do that. The industry did change, but actually perhaps not in the way it may have been originally intended. What actually happened was people just withdrew unauthorized overdrafts. And as a result of that withdrawal of a product and no other replacement, by 2020, there were 16.5 million people who'd lost access to that unarranged product. And that represents in excess of a £10 billion funding gap. So those customers then, as usual with most things, if you change the supply, it doesn't necessarily change the demand for the credit. Those customers look for alternative forms of access. And you could argue it's by no means the sole case, but that has helped fuel some of the growth that you've seen through the last few years in terms of the use of buy now, pay later. And therefore, there has been, customers have looked for more credit from other non-regulated sources, including buy now, pay later. And then just because we think that is a one-off, even if you bring that up to date in 2022, through actions and the banks in terms of the concern about the use of capital. Again, there's been a further 6 million customers who've lost access to an arranged overdraft in 2022. You compound that with what's happened with the cost of living squeeze and the pandemic, and you sit here today in 2023 and you look across the UK economy more broadly, and there's circa 27 million customers who suffer some form of financial underservice. And we believe that creates a compelling backdrop for a large number of customers who can benefit from our product. And so towards the bottom of the slide in the middle, when we've done our research and we've looked at the whole customer UK population, and we will explain this in a little bit more detail, we can get to a target, or not target audience, a total audience of about 29 million customers who would like to use a version of our product. If we then overlay our risk appetite, so the customers we would wish to book and exclude customers who perhaps are subprime, etc., we get to a target audience of a little over 16 million. And that, to us, represents a compelling investment opportunity. You also overlay that with a case of financially underserviced, can't access the product, can't access credit, or may not be able to access credit. And as we'll talk to in a few moments, the potential detrimental harm to credit files. Then there's also a case to say what we're doing is financial inclusion and an opportunity to improve and better people's lives. If we go back to by way of a sort of further recap on our story, our story started as far back as 2017, as Margot and the team thought about the original proposition. We've been through a journey working with our regulators and other stakeholders to where we submitted our application to be a bank in January 2022. We were authorised with restrictions like any new bank who mobilises in the UK. In July 2022, we were granted our banking licence with restrictions. And what that actually means, just for people, is we enter a mobilisation period, which typically takes 12 months. That is the period of time where we build and test our technology and satisfy and work with our regulators and other stakeholders to prove that we are ready to enter the market more fully. We are right in the middle of that process. So at the end of the year, we've delivered our technical solution. We are auditing and assessing the technology platform. We are currently preparing our operational readiness and our operational resilience, including completing user acceptance testing. And then towards the middle of the year in July, subject to the necessary regulatory approvals, we'll have completed our proof of concept lending testing. And upon the receipt of the necessary capital to support our plans over the next 12 months, we'll fully launch the product in July. So that's our compressed timeline of how we go to market for July, and we're right in the middle of that process right now. I said I'd spend a few moments before we get to the bank. There are two opportunities within the business for us, and that's why we've configured the business in this way. So how the four components of the business work is, the first is we have Fiinu PLC. Now, clearly, Fiinu PLC is the listed entity that gives us access to the capital markets to fund our business model. We then have a holding company, which actually holds the intellectual property for the technology plus all of our trademarks and patents. And then there are two divisions below that. The first is our technology division. So this is the bit that builds and maintains our technology solution. And we'll explain how the plug-in overdraft works in more detail shortly. But the reason we have that outside of the bank is we see opportunities beyond the UK for the application of our technology with other providers. So the challenges and the opportunity that we've articulated in the UK exists elsewhere, maybe in different ways, but it exists elsewhere. And we therefore believe there is a meaningful opportunity to deploy our technology and create a second revenue stream. The primary revenue stream is Fiinu Bank, and that is the opportunity to deploy our technology and our solutions for customers in the UK, and we'll expand on that a little further shortly. So, you know, the belief behind our product and to the compelling opportunity in the 10 billion funding gap in the UK is the belief that at one point, you know, everyone needs access to credit, and we believe our product is a great vehicle for doing that. So I'll hand you over to Marco, and then he'll bring the product to life and the customer segments in more detail.
Thank you, Chris. And as you said, I'm going to focus now on the Fiinu Bank proposition and less, of course, on the technology side of things. But in this context, as Chris said, everybody needs access to credit at some point in their lives. But think of a Margot, or me, Margot. She would be a very typical customer of ours. She's a real estate mum, age 35. She's recently got married. She's a very good, normal person. If you think of the bulk of the people, the mass market that Chris was describing earlier on, she would just be a very good, normal, standard person. A few times a year, she needs to dip into her overdraft, or at least used to do that. But if you put this in context, as mentioned already, when we had 33 million or 62% of the population using some form of overdraft a few years ago, and now we've had over 20 million people who've lost access either to arranged or unarranged product. It is logical that people will therefore ask, well, why did they lose access? Especially why the retail banks are not helping. Now, we already covered about the overdraft reform, but it is no small feat that the cost of living crisis, high inflation, and everything else has resulted in banks to change their risk appetite. This is unfortunately what happens typically in a typical downturn. And as a result of that, you could almost argue that when people need these types of products most, not all banks are helping, and that's not necessarily a very good customer outcome in our opinion. The four banks you see on the screen are representative examples. Every bank in the UK have done more or less the same. And we're seeing similar evolution happening also in the US market. They're just a little bit behind us in that curve. There are alternatives, as in any other market. I think it was Andrew Bailey who talked about this waterbed effect. In this scenario, particularly if you focus on the sort of the graphics in the middle, when consumer is about to make a purchase today, that transaction is simply declined if it's about to go overdrawn. Now, oftentimes, and I think most people would do this in a digital or online purchase, they would be offered, as an example, point of sale credit or buy now, pay later. There are, of course, other alternatives. We're just using that as one example. By getting one such credit, or say buy later or buy now, pay later as an example, of course, that transaction goes through and they'll get their groceries or whatever done for that matter. But unfortunately, some of these products, typically, of course, non-bank products, not all, but some of them have quite severe adverse effects on people's credit files. So I think some of the worst ones have an immediate 10% drop in credit scores. This is according to both the FCA as well as some peer-reviewed academic studies. But there are also other consequences, especially towards the first-time borrower mortgage applications, which is also problematic for some of the incumbent banks because that tends to be their core business. And so whilst they're not providing a product, then they're almost forcing their customers to go outside for the non-bank alternatives. And then they have another problem later on when they want to underwrite somebody's, say, mortgage application. And so that is not ideal, the alternatives. Before we talk about the actual solution, we needed to, and we wanted to understand the size of that market. And Chris already covered some of these things earlier on. But the key to this is that we think that there's a massive, huge market, quite receptive for our solution. So in the UK context, we have over 100 million personal current accounts held by about 55 million people. of which 60% would be very likely or somewhat likely to add a plug-in overdraft to their bank account. So that puts it in perspective. And we've got 53% who would be very likely to add plug-in overdraft to their bank account. That's 29 million consumers. I think Chris didn't necessarily explain, but the research suggests that the company would break even with around 234,000 customers. I think this is a question really that people will therefore need to ask themselves. Is it plausible this company will get to about 250,000 customers out of that pool and then therefore reach the profitability? Really the sort of a solution to all of this is, as we've already mentioned, of course, the plug-in overdraft. It's an unbundled solution. So what we're effectively doing is there are others who've unbundled products from a personal current account. Wise is probably the first one that comes to mind. The key is that we're not requiring anybody to switch or change anything. They'll continue to use them, whichever bank or e-money account they want to use as their primary. We're not even providing a new card to people. We don't think there's a problem for people who have any kind of, normally I would say coral colored card, but I do like Monzo, just to be clear. but the key is, of course, that having an arranged overdraft mainstream credit in your credit file will help people to build their credit files rather than erode it. I'm sure people will have questions about this, but it's a very simple product, very neat, and we're very proud of that. So Chris, maybe you could just explain how the business model works.
Thanks, Marco. So yeah, as Marco said, it is a very simple product or products in terms of our overall business model. We really do two things. We take fixed term deposits and we offer a plug-in overdraft. And as Marco's illustrated, we believe the plug-in overdraft works in a completely different way, carves out overdrafts from the existing bundled personal current account arrangement and gives people choices that they didn't previously have. But yeah, our model is simple. It is focused solely around those two products and is digitally enabled by being completely app-based. In that way, obviously, it's very simple for customers to access and control, and also it offers us the advantage of keeping our operating costs as low as possible. But critically to us are the two components. So the first component is a fixed term deposit. So to fund our lending, our overdraft product, we basically take one saving product, and that is a 12-month fixed term product. So let's just say that's at 5%. So we offer in the market a 1-year saving product, competitively priced to make sure we can attract the necessary level of retail savings to fund our overdrafts loans. And then we take that deposit and we then, let's just say it's £1,000, and we then may lend that to 10 customers, £100 each if that's what they're required. But of course, because it's an overdraft and it's used for relatively short periods of time, we lend it for repeated time. So to give you an example, at £1,000, let's say it's 5% interest a year to the customer, it costs us £50. If we took, say, £100 increments at 30p per £100, that's £3 a day of income. Therefore, it takes us 17 days to cover our cost of funds for a year. The remainder is therefore our gross margin. That less our costs and our impairment clearly gives us the profitability. So that's our model in a nutshell. We take fixed term 1-year deposits and then we lend it to multiple customers multiple times. Now, in terms of the customer, just to give you some ideas, our modeling and our experience and the customer research supports the fact that we expect customers to use the product infrequently, which we classify as 6 to 7 times a year, and on average for 10.7 days. So, on average around 11 days. So a customer doesn't necessarily use the product clearly not all of the time and not every month. But when they need it and when they need that flexibility for a bump in the road, they can access their overdraft. It's always available to them and there are 0 fees. So in our model, it is simple interest. We only charge interest for the time you use the product. There are no fees to keep the product open. There are no fees if you don't pay the product in time. There are no other charges whatsoever. So very simple and very straightforward.
And Chris, may I quickly ask you to also quickly talk about the 90-day rules, the 90-day continuous use?
Yes, so to make sure the product remains fit for purpose, one of the things we have a policy that says that if a customer, for whatever reason, continues to use the product for greater than 90 days, we would freeze the product and suspend the application of interest. Again, because we believe that the product is a short-term, flexible product to be used, not a long-term lending solution. And so that's a critical component of our product to make sure that, again, the product is used in the way it's intended and that customers don't receive any detriment. On the next slide, we've done a quick comparison of our main sort of competitor groups, again, by way of example, but we think there are sort of three key sort of categories of competitors, and I'll quickly try and rattle through this. But we believe overall our competition is either unable or unwilling for a variety of reasons to copy or decide to compete with us. In fact, you could even come up with a case that we are complementary to certain competitors, which I'll talk to in a moment. So if you look at our product on the left-hand side, the plug-in overdraft provided by Fiinu Bank, and then you look at how it compares with, say, the legacy high street banks, it's difficult for the high street banks to compete for two reasons. First is the legacy technology stack and the fact that they lack some of the tools and capabilities. But more importantly, it's around, traditionally the high street banks' strategies around bundling. And we are a complementary unbundled product, and therefore, again, a different model and one that we don't feel that they would wish to compete with. Then you've got Monzo and Starling. They're a little bit the same. They're driven by, as an example, the sort of new neobank category. Again, very much driven by a bundling strategy of selling, cross-selling and selling additional products and services. We are a completely unbundled provider, providing a product to customers that they can no longer or are unwilling to provide. And then lastly is the more non-regulated or bank alternate lending solutions, whether that's buy now, pay later, or retail credit or other providers. And again, they've clearly got the risk appetite. They've clearly got, or some of them have clearly got the technology. The one thing they haven't got is a banking license. And you cannot offer an overdraft. It's a restricted term. So only a regulated bank can provide an overdraft. And again, we believe that gives us a significant advantage. And I think, as Margot said, the research also confirms that if you look at the products that people trust, overdraft ranks second after mortgage, so well ahead of consumer loans or credit cards. Customers have a familiarity with how the product works and trust the product second only to mortgages. So that's why we believe we have an advantage versus the competitive environment in the UK. And then in terms of our go-to-market, we'll go to market across multiple channels. It will be supported by, as a startup, a limited amount of above-the-line marketing support. So, our above-the-line media. It will have a heavy PR, social media aspect to it, because we believe, given the underserved market in the UK, the macroeconomic situation in the UK and the sort of social backdrop, it will attract a degree of attention from some of the opinion formers and influencers in that sector. But then we will work with partners, whether that be the more traditional search engine companies, or indeed, your more typical affiliates of accessing other financial services. We've clearly got our own website and therefore can drive organic business as well. And then lastly, our plans do not assume any work with partners, but clearly there is an opportunity for organizations who can no longer provide an overdraft to the existing customers for the reasons we've articulated earlier, there is an opportunity, and a number of organizations have expressed an interest in a conversation the moment we go live, to work with people to provide our product to the customers they can no longer serve. Now, in our plans and our numbers and our customer acquisition strategy, that is not factored in yet, because we recognize that may take some time to set up, but we have not lost sight of the fact that there is a significant opportunity to partner with some of the existing banks. And then lastly, that should lead us to the conclusion, which is, we believe, for the reasons hopefully we've laid out in these slides, that there is a compelling opportunity to use technology in a different way to make customers' lives a lot easier and serve that massive population in the UK that are currently financially underserved. And therefore, we believe we can deploy our technology, use open banking to provide an innovative product that promotes financial inclusion. And that, ladies and gentlemen, is our story. So I believe we're going to open it up to questions, Jonathan, yeah?
Yes, indeed. Thank you very much. Very comprehensive presentation there. I have had a number of private messages asking if this is recorded. Indeed, it is, and it will be sent out probably tomorrow along with the slide deck. The slide deck is actually available to be downloaded now. If you visit the event page and the link to any emails you've got for us on the sign up, you'll be able to download that now. Just a note on the poll that we did on the uptake and would people use the plugin Overdraft. 64% of the attendees said that they would use it. So we're going to get into the questions now. And there's a couple of questions here about the app. One from Alan. And the question is very simply, is there an app ready we can test? And if there's not, when would that be available?
I can maybe answer first that I already have the app on my phone, but you're not privileged enough. Chris, maybe you can explain what the plan is for the soft launch and the final.
Yeah, so the app is in the final stages of UAT and therefore isn't in a sort of retail downloadable form. It's in a test environment, so we can download it onto test devices, etc., and complete all of the customer journeys, but it's not publicly available. The first edition of the app, that in inverted commas, as Marco alluded to, a soft launch is in May. So that will be the first time where someone can sort of download of their own free will. If we do have some alternatives, so maybe we can talk about this later. We have got sort of like a prototype video of the app. If people, maybe Jonathan, we can facilitate. If people want to contact us around that, we can give a sort of demo of how that works. But the first sort of publicly downloadable version of the app will be with our friends and family testing in May.
Thank you. So moving on now, question here from Stephen. It's something you may have touched on in the presentation, but Stephen asks, do you conduct credit checks on potential customers, and how stringent are your acceptance criteria?
So, Stephen, yes, we do. And actually, we do enhanced levels of sort of credit due diligence. So our journey, and this is where in the time allowed we couldn't really talk to it. Our journey actually starts with a automated check on affordability. So we use open banking data with the customer's consent very early in our journey, before we do any of the normal credit checks, to form a view of the customer affordability and our product offering, using basically an affordability assessment from the current account information. We make an offer that we think is appropriate to their affordability. If the customer then wishes to accept the offer and provide some additional information, we then do the more industry standard formal credit checks, including obviously checking with the credit reference agencies, doing the full identification and verification, all the checks that you would expect. But we believe, given the way we're using open banking and the information that open banking makes available to us, our credit checks are at an enhanced level to make sure the product is fit for purpose.
Thank you. So there's two questions here, which I think we can probably roll into one. It's one from Jules and one from Sanjay, which really asks about the alternatives to Fiinu. So Sanjay asks, why would a potential customer not just use their credit cards? And on the same topic, Jules asks, what's to stop the high street banks from reopening their overdraft facilities themselves and squeezing Fiinu?
So shall I do the last one first, if that's okay? And then I'll come back to credit cards. So in terms of the high street banks, to what Marco mentioned earlier on, I think there's been a loss of risk appetite from the banks to provide a product that they can no longer charge a fee for. So quite simply, from a risk appetite, reputational risk, because they can no longer charge fees, they don't want to offer a product to those customers, and so they've withdrawn the product. And actually that has continued. So as we said earlier, there was a reaction 2019, 2020, and it's continued into 22 and 23. So there has been no return in appetite to serve those customers. Marco, anything you want to add to that before I do credit card?
Yeah, I mean, there's more to it, of course. The incumbent banks would need to price this accordingly. And the way the financial promotion works is that the headline figure may look high, although we cap it as Chris explained, the continuous use. And I think there could be, and then there are potential reputational risks for the incumbent banks. This is not a core business for them. I think if you look at the revenues of any of the existing banks, the core business is about mortgage lending. And so whilst overdraft revenues can be large, but in the context of the incumbents, they are small. And I think that is my opinion, probably the biggest individual reason on top of what Chris always said. There are, of course, technology and this bundling related. I'd like to see that somebody goes to an incumbent bank board and says, why don't we start ripping our bundling strategy that we've been building for the last 150 years to part? And it's just, I just don't see that happening. I think much more logically, there will be a possibility to collaborate, because we're not stealing the customer per se, we're just providing something that they're no longer providing to their customers.
In terms of credit card question about why they wouldn't use credit cards, I mean, some customers may. We obviously, I'll give you a use case in a moment, but we believe the product's more flexible. You only pay interest for the days that you actually use the product. A credit card, typically, if you've got a balance and you do not pay it down in full, you pay interest up until the day that they deem you need to pay the card. So there is a difference in terms of the usage and the flexibility. The other thing that credit cards come with is fees. So, one of the great cases and one of the things that research well for ourselves is a customer who, for argument's sake, sees that they have a credit card bill coming up. For argument's sake, let's just say they use £100. They take £100 from us for 7 days. That costs £1.40. They pay the credit card bill with it. In 7 days' time, their income, the salary, whatever comes in, and they pay us off. Costs them £1.40. Firstly, they've avoided a negative outcome with their credit card provider, and secondly, they avoid a £12 charge for the privilege. So in terms of a late payment charge. Now, that to us is a good use of a flexible, short-term, automated overdraft. So, and that is what we provide. We are, if the funds are available in the customer's account to pay us off, we encourage, or indeed the customer can automatically pay us. So if the customer sets the account up, you do not need to use the credit any longer than it is absolutely necessary to use it. And that is what we think separates us from some of the other credit providers.
I think I could maybe add one other point. And this is a fair question, because even the FCA research suggests that overdrafts and credit cards bear a lot of similarities. They are both considered as running account credit products. This is the relationship between the client and the credit provider. The main difference is, of course, as Chris said, in one, there's a card and you've got a fixed payment date, whereas in overdraft, this floats between your account. If anybody has ever used an overdraft, it just floats in and out, in and out. And overdrafts, because of the recent reform, are, of course, under much, much more stringent regulatory environment where no fixed fees are allowed. And again, I would question whether the direction of travel is similar towards the credit card businesses, particularly when you're allowed to go over your limit, as an example, with your credit card, but you get stung by typically a £12 fee by doing that. I think that's very similar to unarranged overdraft by default, but that is not up to us to decide. We're just going to have to see what the policymakers do when it comes to that point. But they're very similar products, technically.
Thank you. So we've got a lot of questions here. We're going to try and get through them all in time. So there's a very good question here from Neil, which is quite well timed, given that we've just had the results from the UK banks. But Neil asks, how do you feel your net interest margins will compare to traditional retail banking?
For an overdraft, they'll obviously be slightly higher than the traditional retail banks to allow us to serve a larger sort of sector of the UK population. But they're certainly not in the subprime. We're not subprime pricing in. As Margot said, it's a 90-day continuous use product. So if you look at the interest we would charge on average across 90 days, it's circa sort of 27%.
Thank you. So there's two questions here which really relate to capital raises that could be on the horizon. There's a question here from Jamie and one from Chris. Chris asks, do you expect to raise additional funding in the medium term? And Jamie asks, does the current financial climate pose a risk to immediate and near-term raises?
So in terms of the first question from Chris, do we expect to raise additional funding in the medium term? Yeah, we've been very clear, like any bank going through a mobilization period, we require capital in order to fully launch. That's to do two things. It's to ensure that we have the appropriate levels of regulatory capital for our first year or slightly in excess of our first year of operations, and we can also cover our working capital. So that is a regulatory requirement to be able to exit. And we've been completely upfront, and we've signaled to the market that is in a range of 35 to 40 million pounds. In terms of the second question, which is, does the climate pose a risk? Well, there's a risk and an opportunity. So I think we all know that the sort of sad reality of the squeezed UK population, and therefore all the evidence points to there's a greater population of customers who are in need of our product than ever before, and therefore there is a compelling opportunity. But nevertheless, certainly the situations in, should we say, Q3, Q4 of last year, which created a degree of volatility and a degree of risk aversion on the UK sort of PLC market, has created some challenging circumstances for all businesses. That said, things seem to have started to normalise more in Q1. So we of course are cognizant to the wider sort of backdrop of the UK investment environment.
The way I would add to that, if I quickly may, is to Jamie's question is, I always tend to look at back and sort of patterns. And so if we look at, we've navigated through quite a rigorous process. We've obtained a license. We've listed the business on a London Stock Exchange. Anybody who's ever done that knows exactly what you have to go through. The compliance and legal paperwork, verifications, and so on is quite a compelling thing to go through. So we therefore have already a very clear pattern that we've been successful on achieving various different things. So last summer, as an example, when we raised in total £14 million in a very, very difficult market, when this is now June when we raised the funds, and July when we entered the public markets. It wasn't very easy, and it isn't very easy now either. But looking at back what we've achieved, you have to form your own view. Are we going to achieve that also going forward?
Thank you. So we've got a question here from Nick, which really goes back to the product and the onboarding process for the clients. Nick asks, can you advise the timeline from application to funds access?
Yeah. So very roughly 3 minutes. So if you download the app, you share with us your bank account details and the minimum amount of personal information, because we use open banking to validate. So you give us consent. We can return a decision, complete our affordability assessment, and make a offer at the end of 3 minutes. The journey, in a way, looks a bit like opening a e-money or a credit account with lots of the other neobanks. The difference with our journey is, whilst we're completing your journey, we're actually also making the credit offer. They're not two independent processes. It's one and the same. So at the end of 3 minutes, you're into the opening of your account and we've made you an offer. Then, if you accept that, you provide the additional information, we complete the journey. And that includes all of the configuration that the customer wants to perform in terms of automating the services, how you want to pay, how you want to be automatically topped up. So, but that's roughly it, roughly 3 minutes.
Thank you. So there's a very good question here from Andrew, and this is very much down to the valuation from a recent research note from Panmure. So Andrew asks if you'd be able to discuss the 1.2 billion valuation that Panmure has provided to Fiinu, and he also asked if you can make some comparisons to Monzo's $4.5 billion and Revolut's $33 billion valuation, and how that compares to Fiinu going forward.
I can maybe give my view on that. So I think our current market cap is somewhere in the region of 39 million pounds. So I think the sort of figures that if having read the Panmure research as an example, the 1.2 million, that was a forward-looking view. It's of course substantially higher than where we are today, let alone if we then I think Andrew used Monzo and Revolut as a comparison. I mean, these two companies are, of course, totally different businesses, and they are some years ahead of us in terms of the customer penetration. But I suppose the way I would look at this is that whilst their business models are different, there are similarities. Retail focused, authorized by the Bank of England. Well, Revolut isn't at the moment, at least. One could say that maybe this could be a good time for me to participate because the valuation of the business is very low. I would just suggest people to read more and do their own research. Read the research that both SP Angel and Panmure Gordon have published. We can't give any guidance, as everybody knows, whether we think it's a good investment or bad investment. Capital is always at risk. So I think all I can say is that some of our peers' valuations are very high.
Yeah, I mean, the one thing I'd just add to that is, versus you want some of the other well-made cases and examples, good and bad, of what's happening. Our model is very much focused on a path to sort of monetization, and we've set out, some of the other cases are some way from delivering the commercial returns that they've promised. We've designed our product and our business model in a different way, both in terms of the banking product as well as the technology revenue stream.
Thank you. So there's a couple more that we're going to try and fly through. Here's a question here from Patrick. Maybe this is one for you, Marco, with your knowledge in the area. But he asked, why does buy now, pay later have a negative credit impact if payments are made on time?
Yeah, this is a good question. I don't think every use case of buy now, pay later will necessarily have a negative or adverse effect on a credit file. But I think there are cases, if we look at the average type of use of these products, especially when people have many of the buy now, pay laters in parallel, The way we're going to have to see how the legislation pans out, first of all, but when the recording, the credit reference agency sharing data obligation comes to force, it could be interpreted in various different ways. Certain lenders could interpret that in such a way that if people have, say, more than one buy now, pay later active, is that person is very, very credit hungry. And being a credit hungry in a credit file has traditionally had adverse effects. We know that from the FCA research, over a 2-year period, people who used points of sale credit had or saw their credit file worsen. I believe that buy now, pay later is a form of point of sale credit. So we're just going to have to see. First of all, the legislation isn't quite clear yet. Once the policy statement is out, and once that data will come through the credit reference agencies by an obligation, we're just going to have to see what the impact is. I think it's a good question overall, and nobody really knows the answer to that. But it's the frequency of use of credit that could become a problematic. And then, and of course, if you miss a payment, that's another thing. But I don't think if somebody uses buy now, pay later 1 or 2 times a year and then pays it off, that would necessarily have a negative impact on credit file.
Thank you. So we've got time for one last question that we're going to try and squeeze in here. And this is from Jis. And there is actually a very good slides that Chris went through in the presentation. But just really asks a question about the marketing strategy and how you intend to target your audience.
Yeah, so as I said, a variety of sources. Some people will, through either above the line or other marketing efforts, directly click through to the product or download the app to start the journey. So, and some of that we'll speed up by offering things like a QR code embedded in the message. You click on that with your phone because it's clearly a mobile enabled product. So a lot of our marketing material and market effort will be all around the mobile phone. A number of it will be from referral from social media and Informer, and then we'll work with the either direct search or indirect. So the affiliate channels, it may not be these, but Compare the Market, Money Supermarket, et cetera, et cetera. So again, where people are looking for flexible credit or overdrafts or access to short term, then we will position our product in that offering in a way that customers then can then readily access.